Welcome to Financial Reporting Conversations, brought to you by Basford Consulting.
We're here to make the unknowns and knowns of accounting, auditing and climate standards known, so you can avoid the blind-threading mistakes and do financial reporting better.
Each episode will unpack what the standards really say, what they mean in practice.
Whether you're a preparer, auditor, director or litigator, our aim is to help you get it right. Many businesses, especially startups, junior explorers, or companies in high-risk industries, faces a crucial question. Can we really continue as a going concern? We recently published a flowchart on LinkedIn, and today we are unpacking what this assessment means, the steps involved, and the disclosures required under IFRS. So Wayne, why is this topic of going concern so important?
Potentially, going concern is the most important piece of information in a set of financial reports. The entity going to survive for the next 12 months, very, very important to a user, to a customer, to a supplier, to an investor. And then, are the material uncertainties that could cause an entity not to be a going concern in the next 12 months? It will fail in the next 12 months. And remembering this is a very sensitive piece of information. In your introduction, you focused on the high risk areas, but the real risk for users, for auditors, for preparers is those entities that are actually not deemed to be high risk, but suddenly they fail. Suddenly they run out of cash. And remember, for directors, audit committees, auditors, this is potentially a very sensitive piece of disclosure. It is almost a self-fulfilling exercise. I tell people there's uncertainty about my ability to continue as a going concern, and suddenly I lose my customers, I lose my key employees, and therefore there is a lot of reticence in certain industries, certain boards, to avoid telling the truth, avoid telling people there might be problems. So it is a very sensitive area.
So where do we find the requirements for going concern?
When we're looking at going concern, it's an unusual aspect. The key disclosures are in IAS 1 in terms of what should be in the financial report, but there's also a very detailed auditing standard, ISA 570, that almost builds on the requirements of disclosure in IAS 1. You know, the importance, the misstatements that can arise from going concern is you simply fail to tell people you're not a going concern, that there is no realistic alternative to liquidation in the next 12 months, but you still prepare your financial report incorrectly on a going concern basis. And again, another material misstatement is that you just do not disclose there are material uncertainties as to your going concern, or you don't adequately disclose what those uncertainties are. I, as an educated user of financial report, if there is no material uncertainty note, if there is no EOM, emphasis of matter paragraph in the audit opinion referring to material uncertainties, I am in my right, so it's perfectly reasonable for me to believe you are going concern and you will be a going concern for 12 months. If then subsequently you fail, you go into liquidation, you run out of cash, I'm misled. And those financial reports were materially misstated, and the audit report is materially wrong.
So there are two main considerations. First, whether the entity is actually a going concern, meaning that whether it has a realistic alternative to avoid liquidation or cease trading in the next 12 months. And second, if it is a going concern, are there any material uncertainties that could impact the status and that these uncertainties are adequately disclosed? So now it might be helpful, Wayne, to talk people through our flowchart that we have published on LinkedIn. What's step one?
So step one, are there any uncertainties as to your ability to continue as a going concern? Could you run out of cash in the next 12 months? Could the situation arrive where you cease trading or have to go into liquidation in the next 12 months?
What should directors and audit committee members be asking management in relation to step one?
Remember, the responsibility of the financial report is ultimately the responsibility of the board, responsibility of the audit committee. So they need to be asking questions of management continuously. Have we prepared a going concern forecast? Have we got a liquidity forecast? Is there any chance that we will run out of cash? Will we need to refinance? Will we need to raise additional funds? Have we got any banking covenants? Is there a risk that we will breach any of those banking covenants? Are we subject to risk from losing a customer? Are we subject to risk from overtrading? Even though we've got a good new business, a good new product, could that cause us liquidity issues? And obviously for directors, constantly they should be aware of, are they able to pay their debts as and when they fall due?
If you're finding this discussion useful, please take a moment to click like, subscribe, and share. It helps others in the financial reporting community discover financial reporting conversations and keeps you up to date with every new episode. And what is the auditor's responsibility in relation to this step?
Going concern is fundamental to performing an audit and is fundamental to the risk assessment process. So in accordance with ISA 315, the auditor needs to understand the business, needs to understand how that business is funded, needs to understand if there's new products, if there's loss of customers, if there's market competition. Those are all part of the auditor's requirements under ISA 315. ISA 240, fraud and fraud assessment, requires the auditor to determine whether there's pressures or incentives that could cause management to be biased or to actually commit financial reporting fraud. Needing to raise finance, needing to raise shares, needing to tell potential investors and financiers a good story obviously creates a potential incentive for bias. We then, of course, get to ISA 560, subsequent events. So when we're performing subsequent event testing, this should also be linked with the concept of, is there any change to the entity's going concern status? Are we profitable? Are we generating enough cash? Have we breached banking covenants? Have we lost any major customers? And then, of course, we have our entire auditing standard on going concern, ISA 570, that explicitly tells the auditor to determine whether there is a realistic alternative to the entity ceasing trading in the next 12 months, to ask for going concern assessment up to the date of the next audit opinion, not 12 months from the date of the year end. And all the disclosures that are required within the accounts in terms of material uncertainties and the obligations on the auditor to either qualify the disclosures are inappropriate or missing. And even if there is no error, the accounts have properly complied with IS1, then there is required to be an emphasis of matter paragraph stating, we draw your attention to note 2 that says there are material uncertainties as to the entity's ability to continue as a going concern.
Okay, so if we've identified there are uncertainties that exist in the business, what's next?
We need to determine whether those uncertainties are significant uncertainties and are material to a user. If those uncertainties were disclosed, would they be material to the user? Would they change the user's view of the entity's ability to continue as a going concern? The common area that auditors and preparers miss is what I refer to as the double jeopardy issue. So, as I said, there is a great deal of skepticism, pushback from the preparer, from the board. We do not want to disclose bad news. We do not want to disclose there is a material uncertainty. We are convinced it is not a material uncertainty. We are convinced that's quite a remote issue, and we are convinced there's a lot of mitigating circumstances that means there is no material uncertainty. And in a lot of cases, at the end of the audit, there is a lot of debate to and fro as to what should be disclosed, all driven by whether there should be an EOM. And in those cases, we end up with, is it a close call? Have we spent lots of time debating whether material uncertainty exists? And if you have made a close call, if it is a key judgment that you have determined it is not a material uncertainty, then you're caught by IS1 again, that rather than disclosing this as a material uncertainty and the going concern, you disclose it as a key judgment, whereby a key judgment is we have determined this situation does not represent a material uncertainty. Very interesting and very technical, but again, if you are missing going concern disclosure and you're missing the key judgment that it's no judgment as to going concern, a user could say, well, I believe this is a solid company. I believe management, the audit committee, and the auditors believe there is no uncertainty. So an interesting technical question on going concern.
Yep. So step 2 is determining whether making a call that there is no material uncertainty is a close call. And so if it is, then we need to make sure that the judgment is being disclosed. So moving on to the next step, Wayne, what if there are material uncertainties? What's step 3?
So step 3, if there's material uncertainties, are they uncertain? Is it uncertain we will continue as a going concern, or turn it the other way around? Is it uncertain that we will be able to continue trading, or is it certain we will cease trading? Is there no realistic alternative to liquidation or ceasing trading in the next 12 months? And if there is no realistic alternative to ceasing trading in the next 12 months, you cannot prepare the financial report on a going concern basis. And the financial report must clearly say, as we are not going to be able to continue trading for the next 12 months, this financial report has not been prepared on a going concern basis.
So to help auditors and preparers assess whether there are realistic alternatives, what are the key questions that they should be asking along the way?
The whole mind of the auditor and the preparer is it realistic we'll be able to continue trading for 12 months? Is it realistic we'll be able to secure financing? Is it realistic that our suppliers will continue supplying us goods and services, especially if we're not able to pay them? Is it realistic our employees will stay with us for the next 12 months if they know that we're struggling, to pay the employee? Is it realistic we're going to be able to win customers? If you're tendering for major contracts and those customers are aware that you're struggling financially, is it actually realistic you'll get new work? Is it realistic you'll be able to sell any assets? Have you got assets to sell? Will anybody buy that asset? And will anybody buy that asset for the price that you're asking?
So moving on to the next step of the flow chart, if there are material uncertainties, but there are realistic alternatives for the entity to continue as a going concern, what should the disclosures in the financial statements cover?
Okay, a few things they should cover. Have management highlighted the key judgments they've made in determining the going concern is appropriate, despite the fact we've got no cash, despite the fact we've got net current liabilities. Despite the fact we're making operating cash outflows, we have determined it is still appropriate to prepare these accounts on a going concern basis. Are there enough qualitative and quantitative details? Are we describing we've got banking facilities, the limits on our banking facilities, the breach of covenants, the existence of covenants, the dependence on banking covenants? Are the assumptions consistent with other disclosures? Do the disclosures work in terms of, have we impaired assets? Have we recognized deferred tax assets in terms of losses or timing differences? Are the forecast scenarios explained clearly? Have sensitivities and reverse stress tests been done? Have they been disclosed? And key to it all, have material uncertainties been clearly identified and updated, and not just frozen at the year end? The situation is you're reporting the uncertainties at the date of the financial report, at the date of the audit opinion, not just citing the position as it was at the year end.
Thanks, Wayne. So we've discussed the steps involved in assessing the going concern assessment and the disclosures required under IFRS. This assessment is critical and ensures financial reports are prepared on the right basis and provides transparent, decision-useful information. Getting it wrong misleads users and carries serious consequences for preparers, directors, audit committees, and auditors. If your business is facing going concern challenges, or if you're an auditor or director needing support, get in touch with us, and we're here to help you navigate this critical process.
Thanks for listening to Financial Reporting Conversations. For guidance on applying accounting and auditing standards, or to access our online training programs, please visit basfordconsulting.com.
Don't forget to like, subscribe, and share this episode with your colleagues and contacts. We'll see you next time, where we make the unknowns in financial reporting known.